Today's Charts That Matter, I am going to highlight a few slides from one of my favorite publications from JP Morgan Asset Management in what they call their Guide to the Markets. Guide to the Markets. It's a treasure trove of data that's pretty extensive, coming in at 70 pages. If you'd like to review the full document, check out the link in the description. The first slide I want to highlight are the quadrants of returns by style and valuation. What you see on this page is across the top for different time periods, returns based upon value, blend, and growth, which is your style, and then up and down, it's based upon the size of companies. So a couple highlights. First, the bottom two quadrants, which highlight returns since market peak and returns since the market low, the peak being February of 2020 and the low being March of 2020. You can see the difference between vesting at market peaks and market bottoms can be substantial. However, even if you bought at the market peak, you have still earned a satisfactory return. The other thing that's notable here on this slide is the longer term performance of the growth style versus the value style, which it has meaningfully outperformed. The next slide highlights consumer confidence and the stock market. I find this slide particularly interesting because I would deem it a contrarian indicator. The Index of Consumer Expectations is from the University of Michigan, and it highlights three areas: how consumers view prospects for their own financial situation, how they view prospects for the general economy over the near term, and their view of prospects for the economy over the long term. What you'll notice on this slide is consumer sentiment seems to run opposite of stock market performance. When sentiment bottoms, it typically means the market and maybe perhaps the economy are bottoming too. So what you'll notice is over this time period, there have been 9 sentiment peaks, meaning consumers are very optimistic. However, the subsequent 12-month return for the S&P 500 is only about 3.5%. There have been 9 sentiment troughs over the same time period where the forward 12-month return is 24.1%. Hence why I consider this perhaps a contrarian indicator. The next chart I want to highlight is investing at all-time highs. And you may recall this was a focus of episode 4 of Charts That Matter. On the left-hand side, we detail some interesting information. That being, over this time period, the S&P 500 typically closes at an all-time high 6.6% of all days. Furthermore, the percent of time that actually acts as a floor is roughly 30%. And perhaps more interesting, on the right-hand side, we detail your potential return if you invest at a day that the market closes at an all-time high versus any given day. The short of it is, there's really not much difference, so don't be afraid to invest at all-time highs. And the final chart is time diversification and the volatility of returns. I consider this one of my favorite charts in the deck because what it shows is essentially your probability of success as your time horizon lengthens. What this chart is showing is the range of returns over various time periods for stocks, bonds, and a 60-40 portfolio. So what you can see is over any 1-year time period, the range of returns is quite wide, and of course for stocks, very volatile. However, as you venture out into longer time periods, the range of return shrinks and the probability of achieving positive return goes up. If you'll notice, over the 10-year rolling period, there essentially was one episode where over a 10-year period you did not make money investing in the stock market, and that was the period ending 2008, because you had the 01-02 recession as well as the 07-08 recession in that period. And of course, as you can also see, over any rolling 20-year period, there's actually never been one where you haven't achieved a positive return. If you have any questions about these charts or any other charts in the Guide to the Markets, please contact us.